Welcome one, welcome all to the Sunday night market update on October 9th, 2011. This is John Galt speaking. Please remember the information contained within this video is for entertainment and informational purposes only. Any financial decisions made with the material included within this video should only be used in consultation with a financial professional. JohnGaltFLA.com and the host John Galt cannot be held liable for decisions made using the information provided. Yes, Laughing Boy is having a good time as the free, not Tibet, TP movement is born in Occupy Bathroom. I have inserted some of the video without the sound because the sound quality was horrible. Hence, why the Occupy Bathroom movement is only going to have a short clip of video. I tried to sit there and do this complete video from there, but the audio quality was horrible. Harold the Duck was not cooperating with me. He is my official protest duck, and I would prefer to sit there and just show you where I was drawing the charts up and the headquarters for Occupy Bathroom. Let's get into the market report. That's why you're here in the first place. Notes were taken there. Dow Jones Industrial Average got up to the 50-day moving average last week, kissed it, did not proceed much further from there. Why is that important? It has made 4 attempts in the last 2 months to get to the 50-day and failed every time, and this most recent one, circled here, is relatively devastating because it looked like on a daily basis we were going to continue to stair step up with fake rally, pump it right through, blow through it. Now it could happen on Monday, no doubt about it. It could blow right through there and continue a long-term trend and try to get up to around 11,400, but I think we're going to be in a trading range. If you look at this weekly chart, you notice that this wedge that started to accelerate up from the bottom, sharply down from the August highs, from the summer highs earlier this summer, June, July. At some point, we're going to have a breakout in one direction or another. I think looking back at 2007 to 2009 gives you some other interesting perspectives when you look at the sharp wedges that occurred then. Each case, it broke down lower until it reached a bottom in March of 2009, and it reversed and started the what I call the faux bull, or the bull crap market, where they just simply sat there and threw money into the system from the Fed and from the government to sit there and try and keep this thing alive. When you look at it from another perspective, it's not over, though. Oh, no. You see, they really are going to do all they can in the NASDAQ also. It's across the board. The NASDAQ got right up to the 50-day moving average, reversed, and failed. Now, the action on Monday is going to be crucial because if it pierces the 50-day moving average, it too could run up further. But it has been an ongoing process. Every time it fails, like it did in on Friday, it does tend to indicate weakness in the overall market. And I don't think any rallies we get past that point, even if we crack the 50-day moving average, as we did several weeks ago, that it's going to be much beyond the 50-day moving average. When you look at the weekly chart, this is a 3-year weekly chart coming up, you have the same wedging formation coming in since the summer. It's going to break one way or the other, either sharply higher or sharply lower. I really am undecided at this point in time. I tend to lean towards the bearish scenario because I think there's no real economic growth to support these markets. If you look at what's happening in 2007 to 2009, this is through the end of March 2009, you see a lot of these high rallies and then sharp pullbacks, another rally, lower lows, lower highs. That seems to be the trend on a weekly chart also. What makes this particularly unnerving, though, is that we seem to be copying the two patterns there right before the sharp breaks in September, October of 2008. If that's the pattern we're following, we're going to break, and we're going to break very, very hard. However, there is good news to this also. If we're looking at a similar pattern that we had in the December through March period, we'll have one more sharp break and then a huge rally out of it. That is a very possible scenario because we're heading into an election year, and traditionally we do not have bear markets going into the election. We might start the year out that way, but I'm beginning to lean towards the one more massive decline, then a huge rally. The S&P 500 is a basket case. It's one of the worst of the broader markets. It's one of the worst performing. Didn't even get to the 50-day moving average on Friday. This is the daily chart. As you look at this, wow. We keep getting up to the 50 intraday and failing. If you look at all of the failures in the last month and a half, it's not a pretty picture. The death cross is still holding quite firm. We are going up on low volume and down on huge volume. Not the kind of news that you really want to sit there and see or study or hope if you're in a bear. I mean, if you're a bull scenario. Here's the weekly chart. The weekly chart has an almost identical pattern to the Dow and the NASDAQ. It looks like it's going to wedge out. I didn't put the wedges on this one because I'm going to show you a different chart to follow up on this. But the wedging at the end of it is the same. It's going to break out of that wedge, and it's not going to be pretty. I think it's going to be a bearish breakdown. The trading range is what has to be violated. We have to get below 1010, 1020 with massive volume. Or if it's a bull case, it's got to get above 1350 on massive volume. Otherwise, we're still going to bounce inside this range for many, many more months to come. I just can't see us doing that. That would be the worst case scenario for the administration. Looking at the long-term 2007-2009 chart, you see how that pattern broke down in the weeklies. This is the weeklies again, by the way, from 2007 to March of 2009. It held a long trading range right up until June, July, and then wham, broke right out of the trading range that it was in. This is what makes me nervous about the current market situation. If we break to the low side, the declines will be as sharp as I thought they might be, and we could easily violate that 666, 680 area on the S&P 500 should it break down. Moving forward, the Russell 2000 is one of the broader, the small caps, and it's been in just a tear to the wrong direction. Every time it gets even a sniff of the 50-day moving average, it blows up. You see the failures that I've highlighted there. There's 4 of them specifically. All of the rally attempts failed. We always ended up with a lower low in the end. If this rally attempt succeeds and gets above the 50-day moving average, I still think we're going to end up with a slightly lower low. On the weekly charts, you'll see this. We're in a long-term trading range. I think it's got a chance to break that 585 on the next breakdown. We'll see how high this rally takes it from last week. If it carries over into Monday, then we've got a really good shot. I mean, we got a good shot at getting back to the middle part of the range, but I just don't see it happening. I think it's going to break down and violate that trading range severely. All right, let's get to the big boys, the Goldman Sachs of the world. Goldman Sachs is technically in the worst condition I've seen it in a long time. What makes this chart scary is that it hasn't even come close to rallying to the 50-day moving average. It's in a long-term declining pattern. And when you take this chart and break it out to the weekly chart, the weekly chart really demonstrates how bad this is broken down. We've broken down back to the February-March 2009 levels. And that's very unusual for a large cap financial. I think it's an indication of there's a major financial crisis brewing. We might get more good news out of Europe on Monday or Tuesday. But when you look at this arrow that I've drawn there, that's the intraday low for Goldman down to 85. We just hit that in the last week. And it goes all the way back to 2009. That's not a healthy looking chart pattern. On a weekly basis, it looks like it's ready to break down further. We are due for a rally in GS. We seem to keep getting up to 100 and failing, becoming the new resistance. What should make everyone worry about this is that this isn't the only financial. I'm just going to pick on a few tonight. Here's Morgan Stanley in absolutely horrid condition from a technical perspective and from every other perspective. The death cross is holding firm that occurred back in May. One rally attempt succeeded in July, only to capitulate down to a new low. Every successive sharp move lower has resulted in a new low. Every attempt, as I've circled here on the chart, to get above the 50-day moving average since July has failed. The attempt last week failed on a daily basis. And when you go to the weekly charts for this particular financial, it's not much better. Morgan Stanley is a sick stock. Not a company, stock. Back to 2009 levels. Actually, back to 2008 levels. It's 2008, 2009 levels are not looking very good, folks. There's a signal being sent by the financials, and it expands just beyond those 2 major investment banks. There's something stirring that we haven't seen yet to come over the horizon. Bank of America has been sending this warning for a long time. It hasn't seen the 50-day moving average in over 6 months. The death cross has been holding firm. I warned you that this stock was in trouble. The company is in trouble. It's holding on to some wounded ducks in there with Merrill Lynch and Countrywide. Who knows how much money that's going to cost them to settle all their real estate issues. And what makes the matters worse, it's still, I don't care how much of a rally, if it gets above $7 a share on rumors and innuendo on Bubble Visions 1, 2, and 3, it is in a long-term declining chart pattern barely holding on to $5 a share. And when you look at it also on a 3-year weekly chart, it goes right back, oh my God, right back to the depths of the 2008-2009 crisis, where it barely survived and in fact kissed $3 a share at one point in time. If we violate $5, we're going to go back and test that low that we saw in February, March 2009. If that happens, that should be your signal that there are major financial difficulties about to impact the United States. I think we're going to see them. And the reason I think we're going to see this crisis emerge is not just Europe, but the currency markets are sending a signal, and we'll use the ETFs just to demonstrate it instead of using the currencies. This is the UUP, the bullish dollar fund. It's run into some difficulties. It broke out. You see the two arrows, one showing the breakout at the top, the other one showing the lower arrow showing the 50-day moving average curving up. But when you look at it from a 1-year chart perspective on a daily closing basis, it's got a long way to go. It's got to get up to 2350 to really truly validate that this move is going to go forth, and it really needs to get above $25 a share to show that this is a break in the long-term trend. It has been in this trading range for years, absolutely years, and it is not indicated that it's going to break above that trading range, but a move above 2350 would be very bullish for the dollar and bearish for the markets. On the flip side, the UDN, the dollar bearish indicator, is also preparing to endure a death cross. We're going to go from a golden cross to a death cross. You're going to see a golden cross in the UUP soon. You've got a death cross in the UDN coming up probably in the next 2 weeks of trading. That is pretty scary. The really scary death cross, yes, from my old death cross video, just occurred though in the euro as demonstrated by the FXE ETF. The euro is showing every indication of breaking down. Now we're going to have some spikes. When I last looked at it on Friday, it was in the 133 range. Right now it's been trading in a range between 130 and 138. I think we might get 1 or 2 more surges up, and then it's going to roll over bad. I think the banksters in Europe are going to lie about it, and then boom, she is going to crash and burn. Folks, I'll try and get more videos up. My time schedule has been all over the chart. I might be having to move here soon, so who knows how that's going to turn out. Hopefully, we can sit there and get our internet up tonight, get this video up in a timely manner. Otherwise, I'll put it up on Monday morning when I return from the office, doing a little bit of work for a friend of mine. This is John Galt speaking. Watch the markets this week. We should rally strong if we're going to follow through to last week's move, and then I have the feeling it's going to fade fast, ugly, deep, dark, and to the end. Stay tuned for more at JohnGaltFLA.com and my show on the Just Measures Radio Network.